Did you know that the average investor underperforms the market by about 1% each year? And here's the kicker. Even the most seasoned experts can make mistakes that destroy their portfolios. In fact, a study from Dalbar found that professional fund managers tend to miss out on long-term gains because they react emotionally to market changes. Shocking, right? But it gets worse. Experts are often the ones who ignore risk, chase trends, or overestimate their abilities, all while losing sight of what truly matters in investing: patience, discipline, and strategy. In this video, we'll uncover 6 common mistakes even the most experienced investors make. From letting fear and greed rule your decisions to blindly following the herd, these mistakes can hurt your portfolio and leave you frustrated. Stick with me as we break down how to avoid them and keep your investments on track. Ready to protect your future? Let's dive in. Chapter 1. The Blind Faith Trap. Overlooking risk in your search for gems. As value investors, we're often so focused on finding hidden gems that we ignore the risks involved. It's easy to get caught up in the excitement of a stock's growth potential. But without assessing the downside, you might end up with a portfolio full of ticking time bombs. Experts, too, can fall into this trap. They may get blinded by the excitement surrounding new tech or biotech companies and overlook critical risk factors like regulatory challenges or intense competition. Warren Buffett himself has said, "Risk comes from not knowing what you're doing." It's a reminder that no matter how good the stock looks, you need to understand the risks that come with it. One strategy to combat this is to always have a risk management plan in place. Don't just look at potential rewards, ask yourself, what could go wrong? According to a 2021 study by Morningstar, the average investor underperforms the market by about 1% annually due to emotional investing and lack of risk assessment. This tells us that even professionals who fail to assess risk carefully can easily get burned. Before you pull the trigger on any investment, ask yourself, is this risk worth the reward? If you're unsure, don't hesitate to walk away. Chapter 2. The Herd Mentality Blind Spot. Following the crowd into dangerous waters. Even experts can sometimes get swept away by the crowd. This is known as the herd mentality, and it can lead to dangerous investment decisions. When everyone else is excited about a stock, it's hard not to follow suit, especially when influential voices endorse it. However, just because everyone is investing in something doesn't mean it's a good idea. In fact, during the dot-com bubble of the early 2000s, many professionals followed the crowd into high-risk internet stocks, only to watch their portfolios crash. One of the key mistakes here is the fear of missing out, FOMO. Investors, even the most experienced, often panic when they see a rising trend and feel they must jump in to avoid losing out. But history shows us that buying into a hyped uptrend is a recipe for disaster. Take the 2008 housing market crash, for example. Many experts ignored warning signs and bought into real estate stocks simply because the market was booming. An effective strategy to avoid this mistake is to make decisions based on data and your own analysis, not on what's trending. Look at the fundamentals, and ask yourself, does this company align with my long-term goals, or am I just following the pack? By sticking to your value investing principles and being patient, you can avoid the pitfalls of groupthink. Remember Buffett's famous quote, "Be fearful when others are greedy and greedy when others are fearful." If everyone's excited, it might be a signal to step back. Chapter 3. The Overconfidence Curse. Why your gut instinct is a portfolio killer. Overconfidence can be a dangerous trap, especially for experienced investors. When we've had a few wins, it's easy to think that our instincts are infallible. But that gut feeling can lead us astray. Even experts can fall into the trap of thinking they can outsmart the market. A 2015 study from the Journal of Finance revealed that overconfident investors tend to trade more frequently and underperform in the long run. You may think that you can time the market or pick the next big winner just by trusting your intuition, but research shows that's a risky approach. In fact, studies have shown that the average investor who tries to time the market underperforms the market by 6% annually. Even the experts who try to predict short-term fluctuations often get it wrong. A smarter strategy is to focus on the long term. Invest in companies with strong fundamentals and solid financial health, and let them grow over time. Don't get swayed by the daily noise of the market or feel like you need to make a move every time the stock price changes. One of Buffett's key principles is to invest as if you're buying a business, not just a stock. This means doing thorough research and resisting the urge to make knee-jerk decisions based on short-term price movements. Remember, overconfidence isn't just about your abilities, it's also about understanding the unpredictability of the market. No matter how good you are, the market can surprise you. Always stay humble and keep learning. As Charlie Munger, Buffett's partner, says, it's not supposed to be easy. Anyone who finds it easy is stupid. Don't forget to subscribe for more insights on value investing and how to avoid the costly mistakes that can ruin your portfolio. Let's dive into the next chapter. Chapter 4. The Emotional Roller Coaster. Letting fear and greed drive your decisions. One of the biggest pitfalls for investors, both beginners and experts alike, is letting emotions drive their decisions. Fear and greed can cloud your judgment and lead to costly mistakes. The market naturally experiences fluctuations, and when things go south, fear kicks in. The instinct is to sell everything to avoid further losses. But research shows that emotional decisions often result in missing out on long-term gains. In fact, a 2018 study by Dalbar found that the average investor earned 4.1% annually, while the S&P 500 returned 10.5%. A significant difference caused by panic selling and chasing after hot stocks. On the flip side, greed can cause investors to make hasty decisions when the market is doing well. The rush to capture profits can lead you to overpay for stocks or invest in risky assets without proper analysis. Warren Buffett has warned time and time again about the dangers of emotional investing, stating, "The stock market is designed to transfer money from the active to the patient." This means that when others panic or get greedy, the patient investor, who remains calm and sticks to their strategy, often comes out ahead. One strategy to deal with these emotions is to establish a set of rules for yourself. Set limits on your investments, whether it's a maximum loss percentage or a target return, so that you have clear boundaries. Having a plan helps you avoid making emotional decisions. It's also critical to remember that market downturns are a natural part of investing. The key is to stay focused on the long-term goal and avoid reacting to short-term market movements. Chapter 5. The Bias Bender. How your mental filters can warp your investment strategy. We all have biases, but they can be especially dangerous for investors. Confirmation bias, for example, is when you only seek out information that supports your existing beliefs. As an investor, this can lead you to ignore red flags and make poor decisions. A 2017 study by CFA Institute found that confirmation bias often leads to investors holding on to losing positions longer than they should. They hope that new information will validate their original decision, even if the facts clearly point in another direction. Loss aversion is another bias that can hurt your portfolio. Research by Kahneman and Tversky in the 1970s showed that losses are psychologically twice as painful as gains are pleasurable. This makes it harder for investors to cut their losses and move on from bad investments. Instead, they tend to hold on to losing stocks in the hope that they'll bounce back, even when the writing is on the wall. One way to counteract these biases is by adopting a systematic approach to investing. Regularly review your portfolio and be willing to admit when you've made a mistake. Don't just keep a stock because you're emotionally attached or because you've already invested a lot of time in it. As Benjamin Graham, the father of value investing, once said, the investor's chief problem, and even his worst enemy, is likely to be himself. Recognizing your biases is the first step to overcoming them. Another useful strategy is to seek outside opinions. Surround yourself with a network of investors who can challenge your thinking and point out blind spots. Don't hesitate to ask for a second opinion, whether it's from a trusted advisor or from a different perspective in your investment group. A diverse set of opinions will help you counteract biases and make more objective decisions. Chapter 6. The Myth of Diversification. Why spreading too thin could sink you. Diversification is often praised as the key to reducing risk in a portfolio. However, over-diversifying can be just as damaging as putting all your eggs in one basket. When you spread yourself too thin, you dilute your potential returns and can end up with a portfolio full of mediocre investments. According to a study by Vanguard, the top 25% of investors with the highest performing portfolios tend to hold between 20 to 30 stocks. Going beyond this can actually hurt your chances of finding big winners. Many experts make the mistake of thinking that the more stocks they own, the less risky their portfolio becomes. However, the reality is that after a certain point, diversification provides diminishing returns. In fact, a 2014 study by the CFA Institute found that holding 50 stocks in a portfolio only marginally reduces risk compared to holding 20 stocks. Beyond that, the extra diversification doesn't provide much additional protection. The key is to find the right balance. Focus on high-quality, undervalued stocks that you believe in. Rather than trying to own a piece of every sector, concentrate on companies with strong fundamentals and sustainable growth potential. This doesn't mean putting all your money into one stock, but it does mean being selective and intentional with your investments. Buffett has often warned against the dangers of unnecessary diversification. In his 2012 letter to Berkshire Hathaway shareholders, he wrote, "Wide diversification is only required when investors do not understand what they are doing. So, focus on fewer, higher quality investments and spend time learning about the companies you're investing in." You don't need to own every stock to build a successful portfolio. By understanding the real meaning of diversification and not overloading your portfolio, you can actually reduce risk and increase the chances of substantial returns. Remember, it's not about how many stocks you own, it's about how well you understand them. This strategy will allow you to take calculated risks and focus your energy on truly promising opportunities. Don't forget to subscribe for more value investing tips and strategies to help you avoid the mistakes that can wreck your portfolio. Stay tuned for more insights in future videos.